Hi and welcome to The Harvest. I'm Carmel Fisher. In today's episode, we'll be talking about winds of change and braving the currents, reshaping global capital markets. If you want to get more of these auto-downloaded onto your podcast software, please subscribe to The Harvest Podcast anywhere you listen to podcasts. I'm Carmel Fisher. This is Winds of Change, braving the currents, reshaping global capital markets. Well, today we're discussing how companies can no longer afford to ignore the voices of individual shareholders. In today's ever-evolving capital markets landscape, a confluence of forces is reshaping how we invest, trade, and perceive financial instruments. From the meteoric rise of retail investors to the growing prominence of environmental, social, and governance factors, that is, ESG factors, the tides of change are ushering in a new era of transparency, accessibility, and accountability. The World Economic Forum identifies 6 issues that will define the future of capital markets. In the wake of the pandemic and an unequal economic recovery, several interrelated forces are transforming the way global markets work. As the world economies rebound, market participants broadly recognize a need for reforms to the established modus operandi to build resilience, to remain competitive in the face of innovation, and to retain their customers' trust. The first one of these 6 is the democratization of public markets. A contingent of retail traders a few months back, non-professional traders that is, on Reddit's Wall Street Bets launched the equivalent of a market revolt by drastically influencing the prices of several publicly traded companies. These episodes cost hedge funds and professional investors, many of whom had been betting against these same stocks, billions of dollars, and raised questions about market practices and resilience. Historically, access to capital markets was highly mediated, available only to institutions or individuals who had the time, money, and resources to manage their assets with the help of brokers and financial advisors. Today, market data is readily accessible online, and new technologies have significantly reduced the cost of trading and other barriers to entry. This means that more people can trade at any time from anywhere. Greater access to new wealth creation opportunities is number 2. Private market investment opportunities with their more lucrative return profiles were historically available only to institutional and accredited investors. This exclusive access was based on a perceived level of sophistication and risk management expertise among these investors. Today, new products are being developed that allow retail investors to allocate capital to private market alternatives. Here again, challenges surface when opening these products to a larger community of investors. People need to know about the associated risks, which differ materially from investing in traditional stocks and bonds. Number 3, blurring of public and private markets. More companies than ever before are entering public markets worldwide. And yet in the United States, we are seeing firms remain private for longer and others electing to transition from public to private. This trend is fueled by heightened disclosure requirements and regulatory scrutiny for publicly held firms, as well as investor eagerness to fund private companies. Firms are also exploring other avenues to raise capital and reduce dependency on equity markets. More recently, we've seen a burgeoning market for special purpose acquisition companies, or SPACs, and as an alternative route to the traditional initial public offering, which is the IPO, many businesses have turned to SPACs as a means of streamlining the process of raising capital in public markets. But increased competition and potential regulatory scrutiny have raised questions around their future. Number 4, concerns around data and cybersecurity. Capital markets processes have become more digital as market participants demand faster execution speeds and seamless access to information. These technologies accelerate changes in the industry, but also raise concerns around cybersecurity and data protection. Data is emerging as its own asset class, and data management infrastructure is a key growth area for traditional financial firms. Institutions are actively seeking ways to leverage analytics to remain nimble and promote growth. The World Economic Forum's FinCyber initiative, in partnership with Carnegie Endowment for International Peace, is working to connect the industry's various cybersecurity initiatives. but questions remain around how firms can innovate safely, benefiting from a more agile use of data while mitigating risks. Number 5, new roles for financial firms. Some functions traditionally performed by large financial firms are being performed by a new set of competitors. As a result, institutions across the value chain are redefining their roles, taking on new responsibilities, partnering with new technology providers, and introducing new ways of operating in order to keep pace with their clients' needs. As of 2020, 250 of the top private fintech startups internationally had raised nearly $50 billion in aggregate funding. These platforms often provide complementary services to those offered by legacy institutions, presenting new chances for collaboration and integration. While industry stakeholders have made substantial progress in understanding how consumer-facing fintechs are reshaping financial services, the role of fintech in institutional capital markets is less well understood. For instance, blockchain and distributed ledger technologies have the potential to disrupt core functions within capital markets, including trading processes, settlement systems, payments, and capital raising. At the same time, regulators and lawmakers are increasingly vocal about concerns around cryptocurrencies, raising important questions around their future viability as an asset class. Number 6. Transparency around ESG. ESG is a top priority for financial firms as investors, asset owners, and corporations navigate their roles in supporting the transition to net zero and stakeholder capitalism, including adopting consistent reporting standards around ESG metrics. Significant questions remain about market structures and tools that are needed to support sustainable investing. Why now? Well, we're living through a unique moment in history. The COVID-19 pandemic has forced reflection and accelerated change, amongst many other geopolitical conditions, and capital markets will continue to evolve as they must in order to be and remain inclusive and collaborative to retain public trust. That's it for The Harvest. I'm Carmel Fisher. Stay tuned for more. Remember to subscribe to Harvest Podcast anywhere you listen to podcasts.